Welcome to Accounting 202, Managerial Accounting at Kapiolani Community College. In this video, we'll dive into chapters 23 and 24 on budgetary planning, control, and responsibility accounting. Most well-run companies do long-range planning and they use budgets or rolling forecasts. Long-range planning and budgeting are not exactly the same thing, but they're closely related. In long-range planning, the company tries to set their objectives and take into account various trends, and in budgeting, they try to set a formal written plan expressed in financial terms. A master budget is a budget that includes a set of interrelated operating and financial budgets, which we'll discuss shortly. Now, what do you do with budgeting? You try to get your company together so everybody's on the same page. They have a shared vision. They know where their company is going. It's a motivational tool. It's a reward tool. And you do comparisons of your actual to the budget to help the company determine how well it's been doing at meeting those targets. So a master or static budget, you can see an example in illustration 23.2. It's quite extensive, but it contains several different components. Operating budgets include sales. And the trick to a sales budget is to break your annual budget into fiscal quarters. And for any percentage increases or decreases, just take the percentage increase or decrease and add it to 100% and then multiply it by whatever your sales is, and then you can get your growth rate and copy that in a cell in Excel in succeeding quarters. For a production budget, the trick is that the sales that you need plus or minus the finished goods inventory change you're expecting is how much you have to produce. So in this example here, let's say that we expect to have 65,000 units of sales and we need 7,000 units in an ending inventory, so we'd have to produce 65 plus 7. But then again, we already have 4 in our beginning inventory, so we really only have to produce 68. Therefore, the actual amount we have to produce, shortcut, is 65,000 plus the 3,000 inventory change. So another trick is your ending inventory is typically based on next quarter's sales. So you have to borrow from the following column and pull that data back into the current one. That means the data that's given to you about sales often has to extend beyond the period of time where you're budgeting. There have to be some assumptions about, for example, next year's first 2 quarters of sales maybe. Now when we're looking at manufacturing costs dealing with, for example, direct materials, we have a different kind of inventory we have to keep track of, and that's our raw materials inventory. The same kind of trick applies here as previously, although in this situation you can see that the ending direct materials is smaller than the beginning direct materials, so the impact will be the opposite of what it was up above. So we take the 32,500 units of assumed units of direct materials that we need, and let's say that we have 3,700 we need in our ending raw materials inventory, but we already have 4,500. So we really only have to buy 31,700 units of direct materials in order to achieve our required production. So the trick here is the ending direct or raw materials inventory will be based on your next quarter's production, not sales, and your beginning direct materials inventory was last quarter's ending inventory, or was given at the very beginning of the problem. So another trick here, the direct labor budget will be based on your production, not on your sales, and your manufacturing overhead budget will be based on your production and then also broken down into variable and fixed. Selling and administrative expenses, relatively simple typically, and they're mostly based on sales usually. On the income statement, the direct materials, the direct labor, and the manufacturing overhead are only used to calculate your cost of goods sold. And financial budgets, entirely different kind of budget. For example, number 1, the capital expenditures budget usually is established on a case-by-case basis. There may be some large purchases that occur mid-period, and just depends on what the case presents to you. Cash budget tries to determine the cash excess or deficiency to figure out whether you need any financing, and also just to tell the company where they're expected to be cash-wise at any particular point. And if you have financing, that'll determine if you have interest payments, and you may have repayment of the borrowed amounts too. Now your production cash flows are going to be largely already determined in the production budget. You'll require some other kinds of cash flows. So there'll be minimum cash balances you have to maintain, so if you fall below that, you'll have to borrow. Your accounts receivable collection will be staggered typically in the following 2 months. So you may say we'll collect 30% during the month of sale, and then the following 2 months we'll collect 30%, 35% each month. Accounts payable, same kind of staggering assumption. And your investing and financing activities may require cash. And then you'd use typically income tax average rates. The balance sheet, many of the accounts will already have been determined by your prior budgets, but you could do, for example, some unusual things that aren't included in capital expenditures, AP, AR, cash, or inventory. A flexible master budget looks back at the activity drivers that we talked about in ABC accounting and activity-based costing, and we looked at things like labor hours, machine hours, setup operations that have an impact on our operating results. Remember that we're talking about operating within the relevant range so that our assumptions are still pretty valid. Now the relevant range is where we expect the range will probably operate within. You can use the flexible master budget to predict your budgets over the relevant range of output. Now this is a lot more complex than a static or a one-shot budget, but it's very useful. So you would, for example, have various costs at various levels of sales and production. And the budget could be used to tell you, based on what you actually did production-wise, how did you stack up against what you should have done for that level of production. So really quite useful and kind of misleading if you don't use a flexible budget. Now a responsibility accounting system is really more like a topic of chapter 24 because we're talking about budgetary control, but it really ties in with chapter 23 too. A responsibility accounting system is one where we try to get the responsibility for costs and revenue down to the lowest practical level of operations where somebody can control them so that we can do delegation of cost control and also do rewards and reprimands based on that level of that person's capability of controlling something. So we have different types of responsibility centers or segments. An investment center is your highest level with the concern of the highest level of management here, and they would earn a profit, and they also have control over their investment funds. In other words, how much of the company's funds they use to obtain equipment or whatever is needed in order to run that investment center. Profit center just generates profits, so it's looking at revenue versus expenses, does not take into account how much funds are invested in that center. A cost center really just incurs costs and expenses. It has no revenue. Classical example of this would be the human resources department. Now, you use something called management by exception to control fixed costs. That means if it ain't broke, don't fix it, essentially. So you look for issues where your fixed costs are different than what you thought they were going to be, and then you generate appropriate follow-up behavior based on that. So direct fixed costs are those costs that are traceable to only one center. If you didn't have that center, these costs wouldn't exist. There are two kinds here: controllable, the kind that can be directly traced to the center and it's under the manager's control, and non-controllable, that's the kind that can be directly traced to the center but it's not under the manager's control, and those shouldn't even show up on that manager's report because they can't control them. They should be, however, on probably the next highest level of report up by that manager's manager. Indirect or common fixed costs are costs that relate to the company as a whole. These really can't be traced to any particular center. You can't tell whether they would or wouldn't be eliminated if that center was eliminated, and these too shouldn't show up on any manager's report below the level of probably top management. So a responsibility performance report is one that tries to peg the revenues, expenses, or costs that pertain to that particular individual who you're producing the report for. So if it's sales minus variable costs equals contribution margin, that's typically a kind of a low level of management, maybe a store manager or below, department manager. If you take their direct fixed costs that are controllable and subtract that, then you get the controllable margin, which is typically useful for evaluating a profit center and beginning to do the evaluation of an investment center. So if you want to do an investment center, you really want to generate something along the lines of a ROI, or return on investment analysis. And that takes your controllable margin and then divides it by your average operating assets, and use that to figure out how well that manager is doing in utilizing the assets that's under their control. Remember, an investment center has the capability to vary how much of assets are used to help them do their job. And so return on investment is a widely used performance measure, and you'll see it in various different forms in management courses and other business courses, entrepreneurship too, and special project ROIs and everything. So very widely used, so you get to know it. Managing your ROI is really a matter of making that fraction look better. So you can improve your ROI by either increasing your controllable margin, which of course everybody's trying to do, the percentage, or by decreasing your average operating assets that are being employed. So sometimes you'll see people saying, yeah, but if we just had da-da-da, we could do a lot better. And I go, no, this is all we got. So basically they're keeping the average operating assets down at a low level so that the ROI pops higher. Now, things that can make that ROI improve, things that make the numerator bigger or the denominator smaller, then you'll get a higher percentage. So good changes would be, for example, controllable margin going up. Bad changes would be it going down. Good changes would be average operating assets going down. Bad changes would be it going up. Thanks for listening. Hope this helps.